All right, let's talk about the stock market. It's full of puzzles, right? But there's one that has had experts scratching their heads for decades. Why do some stocks just do better than others, year after year, in ways our best financial models can't seem to explain? Well, today, we're diving into a paper that offers a completely new and honestly a radically simple answer.
You know, for decades, this has been the central mystery. Economists, investors, you name it, they've all been stumped. We can clearly see these patterns happening in the market, but our most trusted theories, they just can't seem to crack it. So, what's really going on?
Okay, check this out. This is one of the biggest head-scratchers in all of finance. You've got your growth stocks, the flashy, exciting tech companies. On average, they've returned about 8.7% a year. Not bad. But then you have these so-called value stocks, the boring, maybe unglamorous, old-school businesses, and they've pulled in a whopping 25.8%. That gap is absolutely huge, and traditional finance has always had a really tough time explaining it.
And you'd think, with all our sophisticated financial models, we'd have this figured out by now. But nope. The foundational model, the one that started it all, the CAPM, it's off by an average of 5.7% every single year. Even the more advanced, souped-up models are still off by 4% or more. And hey, these aren't just small rounding errors. They're giant red flags telling us that maybe, just maybe, the theories themselves are missing something really big.
So this is where things get really interesting. The paper we're digging into today comes along and proposes a radically simple idea. What if we've been looking in the completely wrong direction all this time? What if we stop trying to explain stock prices by getting inside the heads of investors, and instead, we start thinking like the company itself? The core question is this: what if the return you get from owning a share of a company is directly tied to the return the company gets when it invests in itself? When it actually goes out and builds a new factory, or buys new equipment, or launches a whole new product. What if it's that simple? Here it is, the central thesis of the whole paper. It argues that a stock's return should basically mirror the company's levered investment return. Now, that sounds complicated, but it just means the profit the company expects to make from its own business projects after you factor in its debt. The big idea here? The stock market and the real-world business aren't two separate things. They're two sides of the very same coin. So let's just break down that term, investment return. It's actually really intuitive. It's the bang for the buck a company expects to get. If a company spends $1 more on a new machine, how much profit does it think that machine will spit out over its lifetime? That's its investment return. It's that simple.
So this new model works by getting inside a company's decision-making process. It looks at three key things. First, how profitable are the company's new projects? Second, how much is it investing right now? And third, what does its growth and investment look like down the road? You put those three ingredients together, and you can calculate the expected return. It's a model built completely from the company's perspective, not the investors.
Okay, it's a really elegant theory. It sounds great on paper. But the million-dollar question is, does it actually work? Well, the researchers decided to put this Q-theory model to the ultimate test, a head-to-head showdown with the old-school models we were just talking about.
And the results are, well, they're pretty stunning. They tested it on the famous earnings surprise puzzle. That's the mystery of why companies that report way better profits than expected tend to see their stocks drift up for months and months. The old models were off by over 4%. The new Q-theory model, the error was just 0.7%.
Let's just pause on that number for a second. An error of less than 1% per year? That is an absolutely incredible level of precision. It strongly suggests that this investment-based approach is capturing something very, very real about what actually drives stock prices.
And just to put that in perspective, remember the standard CAPM model? Its error was 5.7%. That's more than 8 times bigger. So we're not just talking about a small improvement here. This is a giant leap forward in our understanding. The proof was really in the charts they published. When the researchers plotted their model's predicted returns against the actual, real-world returns, the data points formed an almost perfect 45-degree line. It wasn't just close, it was a near one-to-one match with reality. Just beautiful.
But, okay, let's be real. No model is perfect. And to their credit, the researchers were very upfront about where this one has some weak spots.
So here's the main trade-off.
The model is absolutely brilliant at explaining the average returns of stocks over the long haul. But when you try to force it to also explain the crazy up and down swings of the market, the volatility, its accuracy on those average returns suddenly gets a lot worse. It seems it can do one or the other really well, but not both at the same time.
And this leads to a second little puzzle. They call it the correlation puzzle. In theory, a company's stock returns and its investment returns should move in lockstep, right? But in the real world, on a short-term basis, they often don't. This model does a great job linking them on average, over the long run, but it can't quite explain that real-time disconnect. So, after all that, what's the big takeaway? Why does this research matter so much, even with those limitations? Well, it's really about a fundamental shift in perspective, a whole new way of looking at things.
For decades, modern finance has tried to explain the market by looking at investors, their appetite for risk, their psychological biases, their behavior. This paper pretty much flips that script. It argues that maybe we should be looking at the companies instead, at their investment plans, their profitability, their actual real-world actions. It's a shift from investor risk to company investment.
So what have we learned? Well, first, what a company actually does, how it invests its money, is a hugely powerful driver of its stock return. Second, this connection helps explain some of those big, long-standing market mysteries, like that value premium we talked about. And finally, it suggests that, on average, the stock market is actually pretty darn smart. It seems to correctly price companies based on how efficiently they're running their business.
And that leaves us with one final, powerful question to think about. If the key to understanding a stock's future isn't buried in some complex financial model, but is out there in the open, in the tangible, real-world actions of the company itself, then maybe, just maybe, we've all been looking in the wrong place. So what do you think we should be watching?